Welcome to the final video of the final exam practice problems. I'm not going to go through each of the ratios and calculate them. I have them here already calculated. So let's just go through what each of these mean. The current ratio is your current assets divided by your current liabilities. This is telling us how quickly a company can pay off their short-term debts using only their current assets. Anything above 1 is good. From 2014 to 2015, this ratio worsened because it decreased. The number of days in accounts receivable. First, you'll need to calculate your accounts receivable turnover. So one of the things here is there's several formulas that are asking you to calculate using averages. I would probably go back and calculate those averages first. So you're going to need them, if not only for one, a couple of formulas. Some of the averages that you'll need are average assets, average common shareholder equity, and average accounts receivable. So average assets for 2014 is your 2014 plus your 2013 divided by 2. Okay? And same thing for 15. You would take your 15 plus 14 and divide it by 2. And then you would do that for each of the equity and accounts receivable accounts. So again, your accounts receivable turnover is calculated as your sales divided by your average accounts receivable. And then you take 365 is the number of days in the year divided by your accounts receivable turnover to get your days in AR. This is telling us how quickly the company collects their accounts receivable. In 2014, they collected their AR in 12.3 days, and in 15 it went down to 11.9. This is an improvement because they were able to collect their sales, cash from sales, even quicker. Our debt to equity ratio is our total liabilities divided by our total stockholders' equity. This is telling you how much of the company is financed by debt versus equity. This ratio is unique because there's no higher or lower is better. It mainly depends on the company's leverage strategy. So here they remained relatively the same. Return on assets is your net income divided by your average assets. However, your net income needs to be adjusted for your interest expense. So it's hard to see here, but your net income, you're going to add back your interest expense net of tax. What that means is you're going to subtract the taxes, which is basically your interest expense times 1 minus the tax rate, in this case 40%. This tells you the percentage of income earned as a percentage of your assets. So higher is better, and they improved year over year. Return on common stockholder is the same thing, except over equity instead of assets. Again, they've improved from 14 to 15. And then earnings per share is simply your net income divided by your average shares outstanding. There's no preferred dividends here. Okay. Here, the earnings per share worsened. This is how much income each shareholder earns per share that they own. Our margin is taking our our net income as a percentage of our sales revenue. That's how much we earn for every dollar. So we had a very low margin for this company, 1% versus 1.5%. That's an improvement because it increased. Total asset turnover is your sales divided by your average assets. So it tells us the amount of sales that we generate for each dollar of assets. And again, it improved because higher is better. ROI is the net income over your average assets. So this was sales. This one is net income. So it's telling you your return on investment, basically. How much you're earning for how much you invested in the assets of the company. Higher is better. So in 2015, again, they improved. And then our residual income. How much income is left after meeting the required rate of return? Here we're given the minimum required rate of return. So we're going to look at our net income minus our average assets times our minimum required rate of return. So again, their residual income improved because they had more residual income in 2015 than they did in 2014. Hopefully these answered some of the questions that you had on the practice problems. Thank you and good luck.